All right, looks like we have a few people joining. I'm just going to give it like 1 more minute before we get started, but welcome everyone. Thank you for joining us today. All right. So welcome. Thank you for joining us as we unveil our third quarter Secure the Bag Financial Insights Workshop, where EMSDC brings financial resources, connections, and advice to the small, diverse business community for the health and growth of your business. Look out for invites for our next updates with other resource partners. But today, I want to thank Truist Bank, one of our national partners. We share the goal of supporting small business development in this region. And I want to thank you for this opportunity to host a Money Mindset series where we could focus on strategically changing our mindsets to secure and maintain financial wealth. So I want to thank Patrick Mosley, Commercial Relationship Manager, Volunteerism and Events Advisor with Truist Bank. Thank you for joining us. And thank you if you joined us for our last webinar. If you missed it, you can locate our webinars on our video library on emsdc.org with other recordings of developmental programming from our partners. So I want to thank you guys again for joining us and let you know if you have any topics that you would like us to speak on, please send me an email at abunch@emsdc.org. We would love gathering some information and share with you guys. So without further ado, I'd like to introduce Patrick Mosley.
Patrick? Thank you, Leah. Thank you so much. And good morning and welcome to all who are on the call and who will view this later. It's an honor to be here with you with EMSDC. Partnering with them has been a great pleasure over the last few months, and we are very excited to have today our second installment for the Money Mindset series, and we look forward to doing a few others throughout the year. Today, I'm going to step out of the way in just a moment so I can introduce you to Jamie Whalen and another colleague of ours, Nick Scardino, who are going to take you through a knowledge-based class today on borrowing. And you couldn't have two better teammates to do it. They're doing what we do here at Truist, and they're living in their purpose and inspiring lives and communities. So without further ado, I'll introduce you to Jamie Whalen.
Thank you, Patrick. I am going to share my screen here so everybody can see that. So we can get started here. Let me know when you can all see that. Are we good? Good. Okay. So as Patrick said, I'm Jamie Whalen. I'm a commercial banker at Truist Bank. I want to thank everybody for attending this workshop. It's part of our financial wellness series and in partnership with EMSDC. So I really appreciate the folks over there helping us to put this together. And before we begin, I would like to introduce you to my co-host, Nick Scardino. He's Senior Vice President. He's a 30-year banking veteran. He provides financial insights, strategic advisory resources, industry expertise to business owners, helping them to optimize their operations and ultimately enrich themselves and their employees and the communities where they live. So I've worked with Nick for over 10 years. I know he is extremely passionate about helping his clients, and he serves on various boards and committees. He's always been a high-performing banker, a leader within our team. Just a fun fact about Nick, in addition to being a banker, he's also a private pilot. So he may slip in some puns or analogies about flying, I'm sure. But in a business, there are a number of things that have to happen to have that business take off, just like in a plane. And to be a pilot, you need to have a lot of training, just like to run a business. We encourage you to learn as much as you can. So I think, the best business owners are always looking to expand their horizons. So with that, we will parachute right into the presentation and hopefully glide gracefully along this journey. So I'll kick it off. We always want to talk about, Patrick had made reference to the bank's purpose is to inspire and build better lives and communities. Sounds lofty, but we do it, through a lot of different ways, bringing our financial resources, but also volunteering through seminars like this one and getting out in the community. There's a really great book out there. It's called Man's Search for Meaning. It was written by a psychiatrist and Holocaust survivor named Viktor Frankl, who spent 3 years in the concentration camps. And it's a deeply moving book, but one of the main points he makes is when you know your why, you can endure almost anything, even as something as awful as the Holocaust was. So I want to encourage all of you to think about your personal purpose, your business purpose, and help to frame that in the decisions you make about your business and the decisions you make in borrowing, as part of your overall strategy. So just a brief slide on the agenda. From a big picture perspective, we're going to talk about the reasons why you might want to borrow, how you can get approved, what kind of amount you should ask for, and then the different types of financing out there and the strategies around that. Some of these topics are, we're going to we only have a short amount of time, so we're going to introduce them and introduce some of the concepts. Some of them we could have a whole class around, but hopefully at least, get you some information, get you some tidbits. And then if there's anything you want to follow up with us on, we're happy to be a help. So Nick, do you want to take this slide and kick us off with why a business would want to borrow? We can't hear you if you're on mute. I don't know if Nick is having technical difficulties, but I guess I'll take it. Why should we borrow? So the number one reason that you would want to borrow is for your business growth. Leverage the assets and the cash flow that you already have. Some people might think of debt as a dirty word, but we're here to tell you it's not. You can use it very effectively to grow your business, but you want to, use it responsibly. You want to be smart about it. Again, it can really help you manage your working capital. A big example of that is if you have you want to buy inventory so you can sell more. You may be still collecting some receivables. So a line of credit could help you fund those timing differences between when you're getting the money coming in versus when you want to pay it out. So again, it's really just helping you maximize that working capital potential. It gives you additional flexibility, and ultimately it can help you retain control in your business, versus, bringing in another partner who may have a financial interest. So again, we want to stress, if you borrow responsibly, it can really help your business grow. And, you can actually earn a better return by, putting money in your business versus, some other project or some other real estate or the stock market.
Jamie, I'm back on. Sorry about that. The dial-in didn't work. I heard what you said, and I second everything you said. One concept of borrowing, another word for borrowing is leverage. And if you think about what a lever is, think of a pry bar. We have a certain amount of strength in our hands, but if you have a lever or a pry bar in your hand, you can magnify the strength of your hand. And that's really what borrowing is about. And there's, in many things in life, there are good aspects of it and there are bad aspects of it. And a crowbar can be used in a bad way. You can break into a locked place with a crowbar, so that'd be bad. But the ability of a lever to magnify force is the concept that you should think about with borrowing. borrowing in a good way should enable you to magnify the force of your business. And it can be a dangerous thing because that force can be applied in the wrong way. And the way to guardrail that, the way to make sure you're borrowing in the right way, is a concept we like to say: productive and non-productive debt. And a lot of concepts of high finance, no matter how big a business is, you can reduce to the simplest terms of thinking of how debt affects you as an individual. So, you have a job, you make an income, and you'd like to have a house, but you don't have $200,000 to buy a house with. So you leverage that income to get a personal mortgage so you can have a house, because that's a good thing to have. And as you pay off the mortgage, you build equity in a house and you have a place to raise your family. The same way, a business, you have a certain amount of income, cash flow from that business. We'll talk about that. And you can leverage that to make the business get to a higher level of cash flow. When you're doing that, that's productive. If you're, as an individual, borrowing for things that are consumed and disappear, that's bad debt. You're putting yourself into almost a bondage situation, and that's not good. That's not productive debt. So a way to think about it: think about an individual. If an individual is borrowing for something good like a house that's going to build an asset, that's a good borrowing. If you're borrowing for food or borrowing to buy gas, that's not a good use of credit, because you're borrowing to get something that's going to disappear and have no value. And that's a way to apply it to business, to think about how to push growth. We'll see that coming through in some of the other slides.
Thanks, Nick. I think that's a great analogy. And I will point out the other thing, if you're borrowing to cover losses that you have because your business isn't making money, that's not a good use of borrowing. Productive borrowing helps you grow. Covering losses is not a sustainable thing. So it's a mindset, and again, it's about doing it responsibly. So what is a bank looking for? There's various things that we look at in underwriting. I did before I became a commercial banker or relationship manager. I was an underwriter, and underwriters will dig apart your numbers and analyze them and look at all the different factors. But these five C's are what we call are the main 5 factors that we looked at, and really being prepared and understanding, how those 5 C's apply to you will help you get a loan when you need it. So the first one is capacity. That's essentially your ability to pay back the loan, the cash flow that you generate. So maintaining good financial records to track your cash flow, your profits, your expenditures, having financial management practices in place will help demonstrate your ability to repay that loan. Before applying for a loan, you may want to make a debt schedule or a listing of the debts and calculate what your cash flows are, which is essentially your net profit, and then adding back in some of those non-cash expenses to come up with a net number and help you understand where you're coming from. The next C is capital. Having, some capital in the business while you're starting out is important. Saving the profits that you make and investing in your business is very important. That's probably a big thing that we see oftentimes is business owners will pull out their profits, and then they don't have a very large net worth, or sometimes their net worth is negative on their balance sheet. And it makes it more challenging to get a loan approved because there's nothing to fall back on. So again, invest the money that you have into your business, keep the profits in your business to the extent you can, And that really will demonstrate your commitment to the business and helping it grow. Conditions, that talks about, the economy and all the conditions going on around us, COVID, and some of these things are out of your control, but knowing that you have resources, knowing that you have mitigants to what are happening in the economy, in the overall world, understanding your particular industry will again help you, get approved for a loan and present the best case possible. Collateral, that's, what do we have that we're able to take an interest in for the loan. So if you're buying a property, we're going to want to take a lien on the real estate. If it's equipment financing, we're going to want to take a lien on the equipment. So essentially it's securing that loan. There may be certain types of collateral that the bank will ask for upfront. And then the last one is the character, which I personally think is the most important. Having that trust in the business and believing that they are going to do what they say they do, that they're going to follow their loan agreements. Those are extremely important. So I would encourage all of you, if you don't have a good relationship with your banker, or maybe you don't even have a banker, establish one. Having a record of being, trustworthy and doing well is extremely important.
Jamie, before you leave this slide, I want to make a comment that is a little bit of a sharp comment, but it'll save everybody who's thinking about a business and borrowing a lot of time, and it'll give you a great deal of understanding about how commercial lending, business lending works. If you look at the 5 C's, every one of them is very important, but there's a distinction between one and all the others. And the distinction I want to draw your attention to is there are factors that are on the screen that will cause a bank to say no if they're not present. But there's only one factor on the screen that will cause a bank to say yes. And what I'm focusing on is capacity or cash flow or the ability to repay. That is the central deciding factor of a loan. And that's true of every type of loan. And again, simplifying it, if somebody walked up to you and said, hey, can you lend me $1,000? The very first thing you're going to think of, and the middle thing you're going to think of, and the last thing you're going to think of is, do they have the ability to pay me back? If that's a no, the loan's no, regardless of all the other factors. And I want to draw that distinction. The other ones have to be there. You have to have good character. You usually need collateral. The conditions have to be right. And you have to have capital, which shows character and conditions and other factors, kind of summarized. But if there's no cash flow, there won't be a loan. And I say that because a lot of businesses sometimes think, well, gee whiz, I have all this property, I have all these assets, I have all this collateral I could provide. I'm a good guy. I'm smart about my business. I'm in a great business. But if you don't have cash flow, there's no ability to repay. So that's the fundamental one that'll make a bank say yes. And the other ones have to be there. But if they're not, that'll just create a no. But it doesn't create a yes. I hope that's clarifying and maybe save you some time. And if you want, Jamie, I'll handle the next one because it is related.
Yeah, and I'll just make the point too. I've seen, where all the other conditions are met, but where character can blow it up. We as bankers, we do our due diligence, we pull searches, we have access to publicly available information. So if there's something in your history that, you think could be an issue, I would really encourage you to tell your banker about it before they find out on their own. I have had cases where people have been very upfront and said, look, I had a bankruptcy 20 years ago. And, but it's all done. I've had a stellar record since then, and we've still been able to approve the loan. The same thing with even an arrest. there are, but they were upfront about it and transparent and let us know ahead of time versus us finding out and it being a little bit of an awkward conversation. So again, just being transparent and being upfront about things.
And that goes right into this. Those factors that we looked at are the financial underwriting factors, but getting a loan and having a great banking relationship and borrowing money, it goes beyond those objective, or tangible, calculatable mathematics. It really comes down to these. It's about relationships. And if you think about it, all of business is relationship. No matter what kind of business you're in, it's important to build relationships with your customers, your vendors, other businesses that are operating in the same realm as you are. And it's true of your banker. So having a relationship with a bank, and what Jamie just described is exactly that. You're having a relationship, and relationships work by good communication. Being prepared is very important. And don't let this intimidate you, but do your homework, have good records. Jamie and I teach a introduction to accounting class, and it's so important to know your numbers. When you come for a loan, we're going to ask some things about the business. We're going to ask some things about numbers. The more you know about it, the more we can help. And then plan ahead. It will take some time to get a loan done. There is a process to it. But what I would say is, don't let that create fear in you. Let that be reason to have a relationship. And as Jamie said, even difficult circumstances, like past history or a challenge in business or trouble in the business, talk to us. A lot of times we have solutions that can help you. And we like nothing better than to use our tools and use our minds and use our experience to help businesses achieve what they want to achieve. So these things are just things to guide you, but don't let them make you think, oh boy, I'll never be able to do that. No, you will. Talk to us and we'll show you how. And our goal, even by doing a course like this, is so that you know as much about it as we know, to give you that confidence.
Yeah, and I'll just we at Truist here, we use a phrase, it's called partner, plan, and action. So have a partner, make a plan, and then take actions. Let your partner hold you accountable to your plan. And if you don't have a partner, you can, go to a branch and get one, for all different levels, even if you're just starting out, we have different people at the bank who can help you. So feel free to reach out to EMSDC and they can put you in touch with anybody at the bank to help you if you need that. So how much can I afford? First of all, before you borrow anything, you got to make sure you can actually afford the payments, that you can afford it, and that, if you run into any trouble, what would happen. You should make sure you read your loan agreements. There's various online tools that help you actually calculate those payments. Your banker can help you with that. I use a pretty cool app that actually Nick told me about. It's called Easy Financial Calculators. It has a loan calculator in there, and it's pretty cool. It's real simple. You put in the terms of your loan, and it pops out the monthly payment. There's also other like cool things in that, like a currency converter. But the point is, if you're going to borrow money, you have to make sure that you know how much it's going to cost. And not just the monthly, but the full cost we're going to talk a little bit about. How do you figure out how much you can afford? Really, that's where budgeting comes in. You need to know what your sales are versus your expenses, and then figure out how much is left over to pay for that loan payment. So we're not going to go too deep into budgeting, but it's something that we highly recommend, even if you just, use a pen and paper to record this information. You can use an Excel spreadsheet. There's different apps. And we'll share one example of the case of Chris Gardner. He was a salesman who took his savings to make significant investments into medical supplies that he was selling to doctors. So he was putting out money up front before the sales were made. And unfortunately, the sales took some time and he fell on hard times. He was living paycheck to paycheck and eventually gets evicted from his apartment along with his 5-year-old son. He ends up having an interesting meeting with a stockbroker, impresses him by solving a Rubik's Cube. And he gets his chance to do a 6-month stockbroker internship and realizes, wow, this could be my ticket. Like, I can make a lot of money with this. However, it's an unpaid internship for 6 months. So he has to figure out, how do I live while I'm doing this and take care of my 5-year-old son? And he figures out something interesting. He figures out if he sells 3 of those bone scanners per month, then he can cover all of his necessities. It sounds pretty simple, but that is in essence a budget. He also works hard. He never gives up, and he ends up the story ends up taking some twists and turns, but he actually ends up writing a book about his life. They actually made a movie about it. It's called The Pursuit of Happiness, and it stars Will Smith. But great inspirational story, and I just wanted to highlight it as a case of just making a very simple budget and figuring out what you need to do. Nick, you want to take this
All
one?
right. Yeah, we said we're not going to get real deep into underwriting mathematics or calculations, but these are 2 big ones that you should know. Anybody who's going to borrow money should know these couple. And we said cash flow capacity is the ability to repay, and calculating that is not as complex as it might sound. It's just figuring out what the business cash flow is. And cash flow is the net profit of the business or the net operating income of the real estate. And that's simply revenue minus expenses. That's what you're left with. And then comparing that to what the annual debt payments would be. So again, the business's income compared to the debt payments. And in figuring out the income or the net, the income or the cash flow, you would take net profit or net operating income from a property, and you would add back anything that's not cash expense, like a depreciation or an amortization. And if there's any interest expense, that gets added back because that's going to be available for the debt payments. And that would be your cash flow. And then that number you compare it to the annual debt payments. And the gist of that calculation is seeing if there's a margin between what your cash flow is and what your debt payments will be. And there should be a margin. And I'll give an example. If your business makes $100, say a month, $100 a month, and your debt payments are $75 a month, then that's a loan we could make because there's a 25% margin in the income to the debt payments. When debt payments are equal to or greater than the cash flow of the business, then the loan cannot be made. And banks always want a margin because things change. Nothing ever happens the same each month. So there needs to be a margin of error, so to speak. And you want that as well as the bank does, because you don't want to have a month where you don't make enough money to make the loan payment and then the payment goes late. And then you're getting into the other factors of loan decisions like relationships. You want to pay your bills, you want to have good character and do what you say. So that's why cash flow capacity is so important. And when you're planning, you look at your cash flow and that gives you answers to how much you can borrow, which goes back to how much could you leverage what you're doing? How much could you ramp up what you're doing to make more cash flow? And I'll give you an example. Sometimes these numbers are hard to think about kind of on the blackboard, but if we think about it in terms of an example, maybe it's clearer. So suppose you have a flower business and you have one driver and one vehicle, and you can get and arrange all the flowers you can do, but you can only deliver so many. So you're delivering them with one truck and one driver, and you're making a pretty good buck doing it. And you think, boy, if I just had another driver and another truck, I could double my sales. So you do some quick calculations and you say, if I doubled my sales, I could make this much more money. And then you look at this much more money and you say, if I was making that much more money, would I be able to pay a truck payment? and hire another person. And that's the analysis that you would do to decide if you should borrow. And that would be productive borrowing. It's borrowing to get another truck and another employee so that you can increase your business size. And cash flow capacity is the way you would figure that one out. So another factor, and I explained, this will not make a loan, but it's one of the factors that a bank needs. We usually have to have collateral for a loan. So in my example of the truck, we would use the truck as collateral. And maybe we would use existing assets of the business as collateral to buy the new truck. So there again, there has to be a margin. So we use something called loan to value, or LTV. And that's very simple math, loan divided by the value of whatever the collateral is. And this is really easy to demonstrate. When you buy a car, they usually want a down payment. If you buy a house, they usually want a down payment. If somebody came to you and they said, hey, can you lend me $1,000? You would say, well, what's the purpose? Well, you know, I'm doing whatever it is. If whatever it is that somebody's doing, it costs $1,000 and they want to borrow all $1,000 from you, you'd probably be leery of it. But if they said, you know what, I'm going to buy a car, it's $10,000, I have $9,000, and I only want $1,000 from you, you can see how that feels a whole lot different. You know, they have $9,000 skin in the game and they're only borrowing $1,000. So loan to value there would be 1 divided by 10,000. The value of the car is 10,000. They're only 10% loan to value. So that's a comfortable loan to value. If it was the opposite, if they borrowed $90,000 and they have only $1,000 in a 10,000 car, then they're 90% loan to value. And that's a little trickier of a loan to do because it's mostly debt. So that's how collateral gets evaluated.
Awesome. Thank you, Nick, for that. So here's some suggestions on cash flow forecasts. Again, we're not going to get too much into how to do this, but as the name implies, it gives you a sense of how much available do you have to service the debt. So probably the most important thing is be realistic. Oftentimes business owners are very optimistic, and that's important as a business owner, but you want to make sure that they're reliable. You want to, particularly, you know, the bank is looking at that. Does this, you know, business provide reliable projections? Are they well balanced? You don't want them to be too conservative, but you want them to be as accurate as you can, and you can, you know, tailor them as things ebb and flow in your business. You want to have control over your cash flow. You want to think about, you know, is there seasonal things that you need to take into account? One of the ways that we talked a little bit about it earlier is making sure that you have some type of system in place, whether it's using accounting software like QuickBooks, or whether it's just pen and paper, whether it's an Excel file, but that allows you to create what if scenarios so you can identify different options. Position your business to take advantage of the best financing available. Again, having that reporting, having an understanding of where you're at, and, you know, having a good projection will help you do that. And then, of course, consulting with the advisors that you have. It's important to have a good banking relationship, and also having an accountant or industry advisor. They can help you as well. So let's parachute into the different types of financing. Nick, do you want to take this one away?
Yeah, absolutely. 2 different types of financing, and most, I would say 98% of the loans that we make fall into these 2 categories. They're either installment loans, or another word for that is term loans, or revolving loans, or lines of credit. And if you think about borrowing, there is some thought around what type of loan fits what type of need. And I'll handle the second one first. If you think about a business and how a business operates, how the engine of a business operates, you can think about your balance sheet. And if you think about your balance sheet, you can picture assets on one side, liabilities on the other. And you can picture the top of the balance sheet, the current assets, current liabilities, and then deeper in the balance sheet, there's fixed assets and longer term debt. And if you think of it in terms of that, you can see these two sections of borrowing. So revolving loans or lines of credit are things that are in the top of the balance sheet, or what we call the working assets of the business, or the working capital of the business, or sometimes they're called the turning assets or the operating assets. So just to give you an example again, I'll use my flower shop. You have to buy inventory. You pay for flowers, they go into inventory, that's current asset. And then you sell those flowers, arrange them, put them in vases, deliver them, and you sell those, and then you have a receivable from the client. The client owes you money. And on the other side, maybe you owe the grower. You owe farms, or you owe maybe larger corporations you buy flowers from, so you have a payable. So while you're putting the flower together, delivering it and waiting to be paid for it, maybe you need money to pay the vendor. So that would be a good use for a line of credit. It allows you to, as Jamie pointed out in one of the earlier slides, have flexibility around the cash flow and allow the working capital to be stretched a little bit while timing differences are happening, because business happens in timing differences. You sell something today, but you don't always get paid today. Sometimes you have to wait for your money. So if you're waiting for money for goods you provided or services you provided, a working capital line of credit is a great use of credit to help your business keep going and produce the next sale, buy the next inventory while money's coming in. And that's faith, that much faith the bank can have in you. Again, if all the other factors are right, we can trust you that you know how to run your business, and we'll give you a line of credit to support those ins and outs at the top of the balance sheet. So that's working capital, that's lines of credit. Different from that is installment loans or term loans. And as the definition says, an installment loan is paid in installments. So it's something big that you have to buy, but you can't pay for it all at once. So you have to pay for it in installment payments. And again, I think of an individual. You go to Walmart and you see the big screen TV and you think, boy, I'd love to have a big screen TV, but I don't have $1,000 right now. So you put it on layaway and you give them $100, and every time you go to Walmart, you give them $25, and eventually you own it. You paid for it by installment because you didn't have a pile of money. And that TV is going to last a while. It's a longer term asset. So bringing that back to business, in my florist example, the truck would be an installment item. You need it. It can really ramp your business up, but you can't pay for $50,000 truck right away. You need to pay for it over time. And the difference between revolving or lines of credit and installment and term loans are where on the balance sheet the assets lie. If it's turning assets up at the top of the balance sheet, it's probably working capital and lines of credit. If it's down further in the balance sheet, like fixed assets, buildings, equipment, vehicles, those kind of things, that's probably an installment or a term loan. And again, a trick here, what a bank can really finance is timing differences. So in either case, whether it's working capital or a term loan, we have to know that you have the ability to repay. That can't be in question. If that's in question, the loan answer is no. But as long as we know there's a certain amount of cash flow, we can handle turning assets, every week, every month, and we can handle longer term things over as much as 20 years. When we do building loans, we lend people money for up to 20, 25 years. So we'll wait that long as we know the cash flow is stable. And that's the case of installment. And you can see what it allows you to do. It allows you to leverage up that cash flow that we're sure of to get bigger assets that you need to grow the business. Hope that's clear.
And I'll just make the point, installment loans typically have a fixed rate while revolving loans have a variable rate. So what's a variable rate? As the name implies, it's variable. If the rate actually fluctuates over time because it's based on some underlying benchmark rate or index. So a typical benchmark rate that you may have heard of is the prime rate. And that's the rate that banks lend to large corporate customers with good credit. So variable rates are usually expressed as a percentage above prime rate. So for example, if you have a revolving line of credit, it might be priced at prime plus 1%. Since the prime rate currently is 4%, your rate right now would be 5%. If the Fed increases that rate, your rate will increase. If the Fed decreases the rate, your rate will decrease. So whereas installment loans are, you typically lock them in, at when you close that loan. So you have that rate locked in for the entire term of the loan. I'll just talk a little bit about secured loans and unsecured loans. I think everybody probably realizes a secured loan has collateral behind it. So it might be a commercial building, it could be a house, it could be a vehicle, it could even be cash or marketable securities. You could lose that collateral if you don't pay as agreed. It is offered as security. In most cases, you won't, as long as you keep paying on it, you don't have any risk, but it provides the bank with some comfort that there is a way to recoup those monies if something should happen. Unsecured loans have no collateral associated with them, so there is more underwriting around that. They are harder to get approved, and often, or more often than not, there are higher interest rates associated with unsecured loans. So another form of short-term financing is credit card debt. For those of you who have new businesses, we do recommend that you get a separate business credit card. For example, Truist offers a Visa card that's true business liability. Some of those cards out there are actual, based on your personal credit, but there's tons of benefits of having a credit card. There's points or rebates that you can earn over time. So you get the benefit of what you spend. It creates some efficiencies for you. The vendors who you're paying with the card get their money right away, but you actually have extra time to pay, based on when your monthly statement is due. It helps you establish business credit when you're getting started out. But we always recommend that you pay it off monthly. Don't carry a balance. Here's a fast example of, two scenarios where, on the left-hand side, the person is only paying the minimum payment. On the right-hand side, they're paying the actual monthly payment. Our suggestion would be pay it off, every month. But if you have to carry a balance, obviously it's more, more important to pay the monthly payment versus the minimum payment. On the left-hand side, it takes you 13 years to pay that off versus only 3 years on the right-hand side. Nick, I'll let you take the next two here.
Yeah, the next couple slides are just pointing out something that should be obvious, but sometimes gets overlooked, and that is the cost of borrowing. Obviously, something that's going to benefit your business must have a cost. And think about it from the bank's perspective. Why would we lend money to a business? Well, we're in business too. And the business we're in is the business of basically renting money. We let you use money for a term, whether it's a year or whether it's several years, in order to help your business grow. But we do need it, of course, to be paid back. So how do we make money renting you our money? We charge you rent on the money, and that rent is called interest. So if you look at the slide, interest is the amount of money financial institutions charges for allowing you to use its money. And in addition to that, there could be additional fees that are related. So hit the next slide, Jane. So I'll give you just a minute to look at this. Just a quick example. If you're buying a car and it's $7,500 and you put $1,500 down and borrow $6,000, there's 3 different offers that you might get from 3 different lenders. One's 3 years, one's 4 years, another one's 4 years, and there's different payments. So how would you evaluate which one is best? Well, you can see that the first one is best from an overall cost standpoint, because the total of the $205 payments is $73.82, and the other ones have higher costs because the rate is a little higher or the term is a little longer. So this is the kind of decision you might make. You might say, you know what, I want to borrow, but I want to keep it as cheap as possible. So you would go for option A. But if you look at the payment and you say, you know what, $205 a month is a little bit much, I could swing $163 a month, then you might go for the 4-year loan, understanding that it's going to cost you a little bit more in the long run, but maybe that extra cost is worth being able to get, and again, my example with the florist, get that truck so you can double sales and do more business, and then that 163 might be more comfortable. So that's just a quick illustration of the evaluation you do considering all the costs.
So let's talk a little bit about prepayment. Obviously prepaying your loan will help you reduce some of those interest costs because you're paying it off early. Generally, if you're paying a partial prepayment, like you're adding a little extra to principal every month, there's no penalty associated with that. You can do that at any time, and you will pay it off early. However, if you decide you want to prepay it off a commercial loan, and it's an installment loan and there's a fixed interest rate, generally there are prepayment penalties. So that's something you should be aware of and look for, and certainly ask your banker about is, hey, is there a prepayment penalty? If I earn extra cash flow, then can I pay it off without a penalty? Because typically, you might see a 5% prepayment penalty in the first year, 4% the second year, 3% the third year, and so forth. Generally speaking, if it is a variable interest rate, there is no prepayment penalty. But for the fixed interest rates, there is a cost to locking in that rate, and the bank does, rely on those estimates of how much you're paying over time. So if you prepay a commercial loan early, that's an installment loan, there generally is a prepayment penalty. So that it's definitely something you should look out for.
So
go ahead, Nick.
just to start summarizing some of the things you'll think about as you go for a loan is you may want to compare different offers you can get from different bankers. And you don't necessarily have to have several banks to do this. Some people think you should have multiple banks. There's good and bad to that. There's good because you can let them compete, and you'll see ads on TV for mortgages. When banks compete, you win. But in a business, it's more important to have a relationship. And what I would say about that is if you have a good relationship with a good banker, you can have him compete with himself. And what I mean by that is tell him what's important to you. Is it important to have the lowest down payment? Is it important for the monthly payment to be the right thing? Is it important that he's helping you with advice, guiding you of how to grow your business well? Those kind of things, become more important sometimes than, some slight differences in terms. But a banker who's, I would say, worth his salt can help you evaluate different options, and a good banker will provide you with different options, even though you're just dealing with one bank. And the more you tell us, the more we can customize what we do. Business lending is very customizable. So if you're dealing with a bank that seems cookie cutter to you, I would say get a different bank, because there's a lot of flexibility based on your business and what your needs are. So hit the next one, I'll cover it together, Jamie.
I just want to also mention too, there is one thing that's very common in commercial real estate, and that's having a balloon payment. Typically, we do have a 10-year term, but your amortization, how much you're actually paying for your monthly payment, may be longer than that 10-year term. So you have the benefit of a lower monthly payment, for instance, based on 20 years, but your loan will actually mature after 10 years. In the majority of those cases, we refinance it at that time, but it's something to look out for, as you're considering the loan that you have.
This is a little hard to see, and we're not going to take much time on it, but this is a term sheet, and this is what a bank will present to you. Once you apply for a loan and the bank evaluates it, the bank will usually show you a term sheet showing you all the terms and conditions of the loan so that you're able to make the comparisons and you're able to see the whole deal. And you may or may not know that it's kind of a point of negotiating. You should know all the terms. You should know what the requirements of the loan are, how it's going to work, what you're required to do, what it's going to take to complete the loan or close the loan. And the term sheet does that. So it's really the way that a bank communicates the deal to you. And it's something you should look for and even ask for from your bank. You know, once you get a good relationship, sometimes these things happen in conversations or a quick email because you have that kind of an established relationship. But in the beginning, it's good to ask for, can you give me the terms in writing? And that way you know what you have.
Right, and I'll just make the point too, a term sheet is not a commitment. So, you know, typically the bank does do some amount of underwriting with a term sheet, but there is some additional questions, some additional underwriting that the bank will have to do, but it gives you an indication of, assuming everything checks out the way, you know, we think it will, these are the terms that we're willing to offer. So hopefully that is helpful. So we are coming towards the end, and I do want to leave a little bit of time for questions, but I just wanted to give you an example of some of the advantages of SBA programs. You may be able to, you know, partner with your bank to have a SBA program where maybe you are able to have a lower down payment or maybe a longer term. You know, there's programs out there where the SBA will fund a portion of it. There's other programs where they will guarantee a certain portion of it. So it allows the bank to be able to do more, you know, take on a little bit more risk. But even with the SBA programs, the business has to show sufficient cash flows to repay the loan. They should have a history of operation. It should be a viable business. But here's some of the options that you know, that the SBA can help with. How much debt is too much? You know, if you're having trouble, you know, saving money, if you're having trouble paying your obligations, if you're having to borrow to pay basic monthly expenses, those are all an issue. If you're only paying a minimum payment or you're using credit cards to pay off other credit cards, you probably have too much debt, and you should be putting together a plan to pay that off. Maybe you need to consider bringing in an equity partner to help you with that. But again, the point is, you know, borrowing is not bad in itself. It can really help you grow your business, but you need to be responsible about it. You need to make sure you're borrowing, you know, with the right reasons, for the right ways. So we're gonna wrap it up, you know, and take some questions. Let me just commend you all for taking the steps to be part of this program and putting the time and effort. You know, it's an inspiration to us when we see business owners who are taking those steps and putting in efforts and learning and making sure that they, you know, utilize all the resources out there available. So Patrick, do you want to share any questions? Patrick or Aaliyah, share any questions that are in the chat, and Nick and I would be happy to answer.
Aaliyah, if you would, the questions in the chat. I just before she shares those, I mean, absolutely great job. I mean, I think you and Nick both tackled some possible misnomers and clarified some things that you know, business owners may be familiar with, but not really have a true understanding of. And you guys did a great job of really explaining it from A to B to A to Z, how the process goes and some different options within. So absolutely phenomenal job. Aaliyah?
Yes. Oh, I was in class over here, Patrick. Thank you so much. We got 30 years of experience here on the call. So I really want to thank you, Nick, for chiming in, and Jamie for putting this together. This presentation was great. And we did have a few questions. This was early in the presentation. We had a question in the Q&A from Skip. He was saying, what I understand that you're saying is a startup or a young business is not a business you will extend a loan to, correct? And I think you kind of answered that question, but if you guys want to kind of go over that question again, just for clarity.
Yeah, I'll take it if you want, Jamie. As I said with the 5 C's of credit, the most important thing about factors of a loan are cash flow. So we have to be able to identify a source of repayment. And if you think about it, again, go back to the simplest illustration. Somebody walks up to you and says, I'd like to borrow $1,000. The first thing you're going to ask them is, what do you need $1,000 for? So loan purpose, right? And you're going to know right away, does that make sense or not? You know, if they say they want to buy cigarettes with it, you're not going to lend them the money. But if they say, you know what, I'm going to buy a car so I can go to work, you might help them, right? You're starting to get toward, and you see how some things are productive and some things are not productive. So right away, that's going to start a lender's thinking about whether or not they're going to make a loan. So a startup or young business, a little bit of a difference there. A startup, it could be somebody with a great idea. So now the bank has to evaluate how good is that idea, right? So if your idea is you're going to sell typewriters, I can tell you right now, we're not going to loan you money because conditions are terrible for typewriters. Nobody uses them anymore. You know, it's hard to sell typewriters. So if that's your idea, it's probably not a good one. And we may advise you not to even do that business because we know that not many people are going to buy a typewriter. So we don't want to discourage anybody, but like the idea has to make some sense and we have to see where it's going to go. And that's where projections come in. So if somebody has a great idea where they're solving a problem or meeting a need and they can give us projections, usually bank can't make that loan because there's no established cash flow. But with SBA financing, there is some ability to finance startups based on projections if the business plan or the idea is good enough sense and can be explained. How exactly are you going to do this? And we can get behind that. If we can get behind that, we can sometimes make it happen. But they are among the most challenging loans to make, and it's for good reason. A lot of businesses start up and never go anywhere. So in order for us to lend money, again, think back to the individual. If you know somebody who's not reliable and doesn't handle their money right, and they don't have a dime in their pocket, and they walk up to you and say, hey, lend me $1,000, you're probably not going to, because the likelihood of it coming back is pretty low. But if you see somebody coming at you and they're industrious and they're always working and they're always, you know, turning things and making things better, and you can have confidence in them, then you might lend them the money because you kind of think in your head, boy, I'd like to see what this guy can do if I gave him $1,000. That's the same way we look at businesses.
And Nick, I'll just add too that, you know, oftentimes we do see startups where they get a loan that may be cash secured, which sounds like, hey, if I got to use cash to secure it, but it does help you establish that banking relationship and some history with the bank until then we're able to release the cash, and you know, we're able to lend on you know, business assets or equipment or whatever, you know, whatever the purpose is used for. So that's an option for business who are just getting out started.
Yeah, and I'll just add a quick note. Sometimes going to a bank to request a loan may not be the best option for a very new business. There's also microloans, there's also grants and federal opportunities out there that small beginning business can seek out.
And thank you for including that, all of your point of views, and keep mentioning the SBA, because it sounds like it's time for another SBA update with me. So I'm going to be putting that together. We always try to stay informed of grants and opportunities that the SBA has. So we'll definitely just, all of the attendees, make sure you look forward to an SBA update, and we will definitely try to get that on the books for you guys. So thank you for those responses. And in response to, I believe it's Tunji, I'm sorry if I butchered your name, but she's asking if we could obtain copies of the slides. Is that okay, Jamie? I usually share them to all the registered attendees. So if you register, then you will receive a follow-up with all of this great information, because I couldn't take enough notes myself, so I could relate to you guys wanting this information. So I will definitely be getting that out. We also, I'm not really sure, is this a question? Oh no, I'm sorry, this may have been Nick responding to me. If we have any other questions, Going down, just making sure I didn't miss anything. I think I had a comment, but I think that you guys may have answered some of these questions that were thought of in the beginning of the session. But feel free if anyone has any follow-up questions. We do have an email address. I could connect you with Jamie or Nick afterwards, but we will definitely be sharing the presentation. And I want to thank you guys again. Please send any suggestions of things you guys want to learn about. This was a great topic, borrowing wisely. Giving you guys a better look at productive borrowing and some of the things you should be looking at when you're going to borrow from your bank, and building a good relationship with your bank is one of the key things that I definitely took away. So I wanted to thank you guys for addressing that. And I don't see any other questions right now, but again, I want to thank my subject matter experts. Thank you, Patrick, for putting this together. And we're looking to get you guys some more educational information in the near future. So I'm going to let everyone have the rest of your day. I hope you guys enjoyed the session and enjoy the rest of your day. Patrick, did you have anything else to include?
Not at all. Everyone have a wonderful day. And if you need anything, don't hesitate to reach out. Jamie, Nick, myself, or Leah.
Perfect. Thank you, guys. Have a good day.